Cool. Well, guys, we'll get started here. Mark Willis, he's a certified financial planner. He's agreed to come on here and talk to us about inflation, how to create our own money supply. It's an exciting topic. He's been a podcast guest on my podcast a couple times talking about this, and he's with Lake Growth Financial. And he is a financial planner, and not just your typical financial planner. And he'll get into all that, I'm sure. But Mark, welcome to the call here. Appreciate you doing this.
Thanks, Brad. We're going through an inflationary world right now, but this is not your average inflation. And I guess it'd be kind of a cool thought exercise. I mean, what would it feel like to be in control of your financial future, fight off the devastating effects of inflation? This is not your average inflation. This is something out of the ordinary, for sure, out of this world. People are living paycheck to paycheck, and they're really getting hit by inflation. I saw an internet meme that had a guy down on one knee proposing to a girl, and he reaches into his pocket and pulls out a dozen eggs to to offer that proposal, giving her a dozen eggs rather than a diamond ring. And at the same time, we're seeing turbulence in the stock market. Last year, we had the worst stock market year since 2008. Some major tech stocks dropped dramatically. I'm thinking about Netflix in particular. Last year was off 85% off of its highs, but the Federal Reserve has and is still very hawkish, meaning they are looking to raise and fight inflation, raise interest rates, which makes it more costly to borrow money. So my question is, what if we could actually benefit from that situation? Not just be protected, but what if we could benefit from it? In fact, what if you could be like the Federal Reserve and just increase your own money supply, which is what inflation is? Inflation is just increasing the money supply. What if you could increase your own money supply? That would help you offset the effects of inflation. More importantly, set you up for financial freedom. So that's what we're going to be talking about together today. Here's all the important legal disclosures I got to put up there. You can take a minute, take a screenshot of that if you want to. I won't be giving any individual tax advice or investment advice. Obviously, we'll be able to chat with you later and set up a time to speak with you. Just briefly, my name is Mark Willis, and Brad, thank you for having me on here. I'm a certified financial planner. I'm a 3-time #1 best-selling author, working in real estate, business owners. A lot of the clients that we work with are in the business owner space, whether they're running their own real estate shop or doing, all kinds of e-commerce businesses, all sorts of businesses out there. But I specialize in working with little-known financial strategies that are custom designed for business owners that are looking for something outside of the typical, outside of your 401ks and your IRAs. So I work with folks that want to grow their wealth in ways that are safe and predictable, and working with folks like yourselves that want, becoming your own source of financing and even creating some tax-free income in retirement. Who's the author of the quote? "A banker is a fellow who will lend you his umbrella when the sun is shining, but wants it back as soon as it starts to rain." Was it J.P. Morgan? Was it Mark Twain, Abraham Lincoln, or Will Rogers? It's Mark Twain. "A banker is a fellow who will lend you his umbrella when the sun shines and wants it back as soon as it starts to rain." That is so true. That's how banks truly, truly work. So my biggest beef with banks is that they seem to be in the business for themselves. And I guess that's their prerogative. It's their business. But, let's go back to about 100 years ago, actually exactly 100 years ago. Hyperinflation of Weimar Republic Germany had reached its peak due to Germany's obligation to pay huge reparations after World War I. Hyperinflation reached the highest point in 1923, where the American dollar, get this guys, the American dollar was worth 4.2 trillion German marks. $1, 4.2 trillion. So it literally took a wheelbarrow's worth of paper to buy a loaf of bread. I mean, in fact, can you imagine just walking down the street with a wheelbarrow full of money? And let's say somebody robs you and they just knock over your wheelbarrow, get rid of all that worthless paper, and just run away with the wheelbarrow. I mean, that's sort of what was going on. I mean, they were using money to keep their houses warm and with their fireplace, right? So they were just wasting money like that. Now, this is actually a chart, the cumulative inflation by decade since 1913. And 1913 is an interesting year because that's the year that the Federal Reserve was born. It was a creature born on Jekyll Island. And if you know what I'm talking about there, give me a thumbs up or something, because the the creature known as the Federal Reserve, the central bank of the United States, was born through a kind of a cabal of bankers off of the coast of Georgia called Jekyll Island. And the goal was to flatten out this volatile banking sector and control the money supply to sort of give us a predictable and safe money currency. So here's how have they done. Here's their report card. We've had low inflation. We had high inflation. But over the long term, you can see prices have risen on average in the last year, 6.6%. But look at some of this here. We've had over 2,500% inflation over the last 100 years. Can you even imagine that right now? So this is not just compounding. It's compound interest that vaporizes your wealth. So as you can see here, we've had 2,555% total inflation since 1913. So in other words, something that cost us $100 100 years ago would cost us $2,500 today. All right, so a car back in the day, let's say a $30,000 car, would be, not a lot of money. Let's just say it that way. $30,000 divided by 2,500. Yeah, it's like $1,100 to buy a car back in the day instead of 30 grand. So we've had enormous amounts of inflation. The only time we had deflation was in the Great Depression. Over the last 30 years, our population in the United States, this is going to blow your mind, guys. Our population was 250 million bucks, and the M2 money supply. Now, by the way, the M2 money supply is the amount of money that's just sort of sloshing around out there in the world. So the amount of dollars in people's bank accounts and wallets and so forth, it was $2 trillion in 1990, and we had a population of 250 million. So for all of us, we split up the pie, $2 trillion pie, amongst us 250 million Americans. Now, whatever, 30 plus years later, we're up to 330 million people. That's a 25% increase, but we now have $22 trillion in the M2 money supply. That's 1,000% increase. Now, do you feel 1,000% wealthier than your parents might have felt in 1990? I don't feel 1,000% wealthier. Good night. So what does all this mean? It means we're being taxed. It's a stealth tax. The government is destroying the purchasing power of our money, which is a stealth tax. It's actually more deadly than a tax increase, because when we have a progressive tax system like we do in this country, we have different people, usually the wealthy are paying more taxes than the poor. But with inflation, the poor hold the hardest brunt of inflation. Inflation is more fierce when you have to pay more of your income toward groceries and gas and things that are affected by inflation. So it's just not cool to see this sort of inflicted on those that can least afford to pay it. All right, so how can you protect yourself from all this madness? Well, some people say stocks, some people say real estate, since they always do well and beat inflation, right? We'll talk about that. Some people are jokingly say we should just switch to bug protein and lettuce. I'm not making this up. I've seen articles. Hey, this inflation thing sucks, but why don't we just switch to single-ply toilet paper and eat more bug protein? Yuck. Well, some people again say stocks are always going to beat inflation. Why don't we just put all our money in a 401k or IRA or something? Well, let's take a look at this. Has stocks always beat inflation? This is an interesting picture here. This is the stock market from 1913 up till roughly today. And so what's the real return you can get on a stock market account in any given year? What do you think? What is the amount of money you could get in return on the stock market for any given year? Feel free to jot it down. I want you to make a mental note of it if you don't. Really put yourself in the shoes of an investor. What would you require? What I've circled here is what we call the Roaring 20. The Roaring 20. Look at that massive jump up. It was this 20-year period where the baby boomers were coming of age and the 401k was born. So realize the 401k is just about 41 years old. It's so young, it's not even old enough to retire yet. Let that sink in for a minute. The 401k was born then. The boomers were coming of age and getting their day jobs then and pumping money into the markets. And look at what happened. It's a great day for the stock market. We call that the roaring 20, and that's when we averaged 12%. But look at how it's sort of just basically remained volatilely flat ever since. And even as we get to this year, it's going to be a question of how far we have to go. It's been very boring. The second set of pictures here, just after that circle from 2000 to 2020, I call that the boring 20. The boring 20. So from the roaring to the boring. Get it? And in fact, if we were to look at the years 2001 to 2013, we lost a dozen years. Literally, the stock market started and stopped at the exact same point. So if you just plug some money into your accounts in 2001 and then took it out in 2013, you'd literally have no more money than you put in there. That's just unacceptable for most people. They don't have a dozen years to lose. I don't think many people do. So the real return of actual investors is pathetically small. This is according to third-party research. Every year, a Massachusetts-based research firm, Dalbar, does this report for real investor returns. And what they show here is that over a 30-year period, this is not me saying this, this is a third party doing their research. They've been around for almost 80 years now. But Dalbar says that asset allocation investors, these are people who've got their money in mutual funds, index funds, things like that, target date funds, the blend of the markets, basically. They're getting no more than about 2.29% over 30 years. Over 30 years. Now, if you're all in on stocks, if you just dumped every last penny into stock funds, no bonds, no risk off, just all risk on, nothing but, and you kept it there for 30 years, you would average 5%. 5%. Now, guys, remember, inflation was 3.6. So if you've got a typical blend of stocks and bonds like most portfolios should have, you're not even keeping up with inflation. In fact, the Dow Jones, if we were to keep up with inflation over the last 20 years, the Dow Jones would have to be closer to 50,000 points. 50,000 points. Where are we at today? I think it's like at 32, 33. I need to go check. But that's just dramatically small regarding the real returns of the market. So the next question is, what's going to happen when all these boomers finally retire? They're all starting to retire. 10,000 baby boomers every day retire, and will for the next 20 years. So as they're sucking money out of their stock accounts to spend on the grocery store and on the grandkids and all that, what's going to happen to the stock market? All right, so I'm going to keep us moving here. So the stock market has never been a place for folks to save. I'd say it's a fine place to speculate or invest, but it's not a savings asset. But most people put most of their money into things that they can't access and cannot control. So it's like a financially unstable pyramid. 47% of Americans say that they could not come up with cash for a $400 emergency. They'd have to go into debt if they had a $400 emergency. So you think about that for a minute. That's according to a report from the U.S. Federal Reserve. Now, over the last years, let's say over the last 5 years, how many of you guys needed your roof replaced? Or maybe your kid needed some help, or maybe you got hit with a tax bill or had a car repair or job problem or job opportunity. If all your money is tied up in things that you can't get access to, which would be your 401ks, your stock accounts, your home equity, if we don't have much in terms of safe and liquid money, we can't really do much with our pyramids. We're locked up. What I would suggest and what I try to do for my clients is we try to flip that upside down and create a financially strong foundation of safe, predictable, liquid money, and then take significant risk at the top with money we can afford to lose. So that's kind of my prerogative, my personality, my approach. Now, I take significant risk in my business and in my investments, but I know it's coming from a place of solid foundation that even if it all went to zero, I wouldn't bat an eye. It would not matter. All right. So we've talked about stocks. Let's talk about bonds. Well, guess what? Bonds are crashing too. Not that James Bond, but bonds are crashing too. They had their worst year in 45 years last year. Stocks and bonds went down together. So how's that possible? Well, we don't have time much to get into it now, but it's hard to know why and what will happen next with bonds. So some people say, well, forget all this stock account stuff, these bonds. Well, let's just go buy a house or go get some real estate. Let's go get some real estate. Real estate beats inflation, right? Well, that's true. It may be. I mean, there is a level mortgage payment, so that beats paying rent, I guess. You know, when rent is going up, keeping up with inflation. When you buy a house, you typically have a level mortgage payment, which means you're actually getting a discount every time you have inflation on your level mortgage, your flat mortgage payment. But one of the big problems with real estate in the face of high inflation is interest rates are going to go up. And that means higher and higher and higher mortgage rates. I've had folks who have 11% HELOCs. 11% on a home equity line of credit. You think that might be why some folks are not maybe calling you back to do that repair that they needed? Probably. So if you've got a budget of $1,000 or whatever, or $2,000 on a house, and your mortgage just doubled, then you might have to buy half the size of a house, or not buy a house at all. So I like to talk about airplanes. Anybody here have a pilot's license? Out of curiosity, there's always one in every group. Anybody here? Brad's nodding there. You got a pilot's license, Brad?
I don't. He's not in here. Frank, he's a helicopter pilot.
Oh no way. Cool.
Yeah.
Well, he'd be able to talk more about this than I could. I've only flown a airplane a couple of times in my life. Someone just handed me the stick and just said, "Try not to crash." One time it was right over Lake Michigan, right in front of all those beautiful downtown Chicago buildings. But one thing you learn very quickly is your airplane is never flying in a vacuum. It's always in an environment. And in the case of sometimes you're flying in a storm, faced with some significant headwinds, it can be very dangerous to fly that little airplane. So I want to imagine, like, Brad, let's say you do have a pilot's license. Let's say you got a little propeller plane and your airplane can fly 100 miles an hour going at its fastest, 100 miles an hour. All right, so you get your airplane up in the air. You're trying to fly. Let's say you want some deep dish pizza here in Chicago. So you're flying towards Chicago and you get a headwind coming at you. Remember, your airplane can fly 100 miles an hour at its fastest, but your headwind coming right at you is pushing you at 200 miles an hour against you. Does it matter how fast you try to fly that plane? Are you going to get to Chicago at any time soon?
No, I'll probably be flying backwards.
That's right. Yeah. So this environment is influencing what you're doing. No matter how hard you push and shove, you're moving out to the ocean rather than maybe towards Chicago. So eventually you got to wait for that wind to change, right? Most people think that the headwind is just, what is the headwind in this analogy? It's the interest rates on our bank loans. It's the credit cards. Credit cards have gone up to 24% average interest rate on a credit card. So we got all these headwinds coming at us. Customers aren't buying like they normally would. They're buying less when they do buy. So your airplane is getting push against that headwind. Now, most people think wait for the wind to die down and wait for that nil wind when there's no wind at all. Now we can fly our airplane towards Chicago to get that delicious deep dish at 100 miles an hour. Most people think that's the right way to go. Wait for the wind to die down. What does that mean? That means we save in our bank accounts and we pay cash for everything. Just save. What's this banker? I don't need him. I'm just going to pay cash for everything. And there's a reason and there's a place for that, but I'd like to say that's short-sighted. We'll talk about why in just a minute. In fact, it's dramatically dangerous to pay cash for everything, and it won't get you to where you want to go very fast. How can you get to Chicago even faster or wherever you want to go? Get a tailwind. We need to blow from behind our little airplane. If you've got a tailwind, 200 mile an hour tailwind pushing you plus your airplane's engine at 100 miles an hour, Brad, you're getting to Chicago by lunchtime. Yeah. So most people think the best they can do is just pay cash for everything. But I'm here to say there's a better way. We're going to talk about how you can influence the environment around you to give you that tailwind and to become even better than debt-free. All right. So paying cash is not the answer. In fact, if you can go from a headwind to a tailwind, everything changes. But you got to be patient. The winds always change. In the meantime, fill up your gas tank. We'll talk about how to do that here now. So what if you could grow your money at a faster and faster rate every single year, no matter what? What if you could keep your money available for whatever you needed? What if you had a plan to be financially free without taking any unnecessary risks? And what if you owned and controlled the outcome of your financial life before you even started? Wow. That would change everything. So what are our options without cash? Remember that old quote by the banker, right? A banker is a fellow, what? Who will lend you his umbrella when the sun shines, but wants it back as soon as it starts to rain. So if we don't have liquid cash, like that unstable pyramid, if we don't have cash, what are our options? We got to pull equity from our house. We got to put it on credit cards. We got to take out a personal loan. Maybe we got to sell a bunch of inventory and equipment, or even, withdraw from our retirement accounts. Well, let's talk about lines of credit really quick. Where are we today with lines of credit? Business lines of credit, home equity lines of credit, all of them have rates going up dramatically. Anybody have an example or experience with a line of credit lately? Maybe your business line of credit getting squeezed or rates going up? Love to hear the stories.
We've definitely heard of the stories of like banks calling, real estate portfolios due. Like, hey, you got 200 properties, you got $1 million out, we're calling it due.
Whoa. Wow.
You ever heard that?
Unfortunately, yeah, there's a guy, I've had a guy, he had $1 million line of credit for his business, and he operated out of it every day. And the bank just termed it out over 5 years. So the bank called him up, said, hey, we're exiting your business. You need to pay us $1 million. We're done. And this is in the recession. So he was, freaking out. How am I going to keep the lights on, cover all my employees? And so over time, he paid those banksters off. And he said, I want to never see those guys ever again. I never want to darken the door of a bank ever again. So he became his own banker. We'll talk about how to do that as we go through here. So, all right. So banks are under significant pressure. Lines of credit can be frozen or called, like my buddy, that guy I mentioned there. So, cap rates are getting squeezed. You said the bank can call you on your $1 million portfolio, whatever, your 20 property portfolio. And now the rates are going up. Like I said, I'm starting to see double-digit HELOCs, double-digit home equity lines of credit. That's going to squeeze into profits. So one of these questions that finally we get around to with a lot of our clients when we sit down and have one-on-one conversations with folks, we like to start with a question somewhat like this. Hey, what do you want your money doing for you? What do you want your money doing for you? Because where you keep your money makes it do different things. A savings account is different than a hedge fund. That's pretty obvious, right? But most people never stop to ask themselves, what do they truly want? So guys, what do you want your money doing for you? Think about that for a minute. In fact, write some things down if you can. What are some characteristics or attributes that you want your money doing for you? I've got a little list here and I might spur some thoughts and ideas. What about this? Just give yourself a checklist here. And if you jotted this down, seriously, it would save you a lot of pain going through your life, financially speaking. What do you want? What do I want my money doing for me? Just a yes or no to each of these. So for example, do you want your money to be safe? Is your money safe? Can you lose money? Are there going to be any guarantees? Are you going to grow your money guaranteed? Or is it going to be subject to risk? Are there penalties to access your money? What about liquidity? Are you able to get access to cash if you need it for any reason without a bunch of promises and credit checks and background checks and all that? What about leverage? Can we use this money to create the most amount of wealth for the least amount of capital? What about tax advantages? Does this thing grow tax deferred every year? That'd be really cool. Savings accounts don't do that. What about tax-free access to the money? Is it available income tax-free anytime I want, including retirement, when tax rates are likely going to be higher? A lot of folks think taxes go down in the future. No. Take a look at the tax rates. Take a look at where we're headed as a country. What about privacy? Do you want your money private or do you want it exposed? I want my money private. Is this money protected, truly protected? What if you had somebody slip and fall? Do you want to make sure that your money, your family's money is safe from anybody who might try to sue you? Hate to say it, but it's a matter of when, not if. What about collateral? Is this the type of money that you can use as collateral? And ultimately, what about transferring it on to your next generation? How can you give this to the next generation without leaving a tip to the IRS and Uncle Sam? So that's my short list. Brad, any feedback, comments on that list? Anything else you'd add or feedback on that?
Or if I get unmuted. No, I think you got them all. I think you got the main ones.
Yeah, it's my short list. You know, some folks, they start asking these questions, they kind of feel like they're trying to deal with something illegal. But I promise, we're just having a thought experiment here. You know, can we even have this thought? Or is this only for people who are money overlords that are allowed to think these thoughts? No, I think we can all have these thoughts.
It's
This
only
is
for the wealthy. The poor aren't
right.
allowed to have these thoughts.
I know. It's just not fair. But I'm here to say you can think different, and you're allowed to, for sure. So this is kind of that same list of questions just put up in a spreadsheet format. Most Americans put their money in IRAs. You can see them at the top there: 401ks, brokerage accounts, your house, paying off your home mortgage, whatever, CDs, bank savings accounts, annuities, and real estate. I bet you if we did a poll, 95% of the net worth on this call here would be in these different assets. Now, I'm going to show you the answers to the questions. Is there risk involved? Are there guarantees? And if it's bad, you're going to see a red answer. And if it's good, you're going to see a green answer. So for example, CDs and bank savings accounts are not at risk. You cannot lose money, so that's green. But look at all the red on the screen there. Yeah, it's a ton of red. So most people are putting money in things that are against their best interest. In terms of money being protected from creditors, all of it's exposed to creditor risk, lawsuits, bankruptcy. Your answers probably look something like this. And yet we're putting our money in things that are totally against what we want our money doing for us. And when I saw this the first time, it melted my brain. I said, I got to find out, where can I put my money so it's acting the way I want it to act, so I don't have to go working as a slave for this thing for the rest of my life. So the question is, does anything like the right side of my screen actually exist? And as a certified financial planner, I dug into hundreds of strategies, and there are tens of thousands of different approaches to money out there, but there's no need to reinvent the wheel. The answer is yes. Something like that actually does exist. So again, I have to tell you that as a certified financial planner, I did not dig into money with a preconceived notion of what I thought it should be like. I just needed to have a way to save for my future and pay off a ton of student loan debt that I was stuck in. And when I finally stumbled across this strategy, it almost sounded too good to be true. But I can tell you now, after over a decade of working with clients, it's been more than true. It's worked for me. It's worked for my clients. And it's among the multiple tools. We are a full financial firm, but this is among the tools that I feel like needs to be shared with a lot of clients, and specifically business owners like yourselves. And that is high cash value, dividend paying whole life insurance, otherwise known as BankOnYourself. Now, the more I studied this particular tool, the more I could not turn away from how unique and mostly forgotten it is as a financial vehicle. It's been around for centuries, but I think most people don't realize what it can help you accomplish. So take a moment with me and just let me walk through this with you. So first and foremost, I got to say, this is unlike traditional whole life insurance. It's certainly different than what Dave Ramsey or Susie Orman talks about. For first and foremost, it's categorically different in several ways. First, we are lowering the expenses and the commissions by 50 to 70%, which first and foremost, the big complaint a lot of these radio infotainers like Dave Ramsey talk about is that this is a very expensive insurance policy. And I would say, well, what's more expensive? This or paying for a term insurance policy that never pays a claim, and you just wasted all that money for 30 years. But anyway, this cuts the commissions down by 50 to 70%. We're allowing all the money you would have paid in commissions to flood directly into your asset called cash value. Cash value is different than death benefit. The death benefit on life insurance is kind of obvious. It's what you give your family when you die. But the cash value is what you can use while you're alive. And what we're saying is we're flooding that cash value part by 40 times more than old-fashioned whole life insurance would have had. And this has an increasing death benefit as well to keep up with inflation. Now, this starts with an instant legacy. Since you're buying life insurance, instantly you create a gift to your family, more than you could save for them in anywhere else. Second, we're building up a cash value day one, month one, you have access to money you can use, liquid cash, okay? Next, it grows on a predictable and even guaranteed basis. Let me say that again. It grows guaranteed every single year, regardless of what the stock market's doing or real estate market is doing. We have access to the liquid cash value at any time. Even if banks stop lending, you have access to your money at any time. And it's even tax-free if we designed it correctly. So it's like an unlimited Roth IRA, but without all the red tape or restrictions of a Roth IRA. And lastly, and maybe most profoundly, you can borrow against the life insurance cash value and it continues to grow even on the capital you borrowed. So if you got $100,000 in cash value, and let's say you need $30,000 for a piece of equipment or a new truck or something, 70 grand, let's say it's 70 grand for a new truck. You got 100 grand in your policy, you need 70 grand for a new truck. You borrow from the policy and the policy will continue to grow and compound on the full $100,000 as if you had not touched a dime of the money. And you're driving your truck around too. It surely is unique in the financial universe to see something like that. Now, we mentioned access, so let's talk about the liquidity. You can borrow the money at any time for any reason. Nobody's going to ask any questions except how much do you want and which bank account should we send it to. Next, like I said, you continue to grow and earn money in the policy as if you had not touched the money. And you can even benefit from the policy loans that you're borrowing from. You're banking on yourself. So like I say, you can borrow 85 to 90% of your money for any reason, typically below market rates. Interest rates over a 4 to 5 year period is going to be in the APR range, annual percentage range of about 2%. Cash value will continue to earn interest as if you've never borrowed the money, giving you uninterrupted compound growth. And the loan interest goes to the general fund of the insurance company, where it's paid as dividends to you and to all the policyholders. And Benton says, in the event of death, that 70 gets pulled from the death benefit. That is correct. So what happened? Let's say you had that, let's say I did it because I'll die in this scenario. So I'll just use that example. So let's say your death benefit was $500,000 and you had $100,000 cash value. You borrowed out 70 to buy that truck. Here's what happens. If I slip on the banana peel right after I buy that truck, my family gets 500,000 minus 70,000, so 430 grand, income tax free. Remember, my cash value only had 30 grand left in there. Plus, my family gets the truck too. Pretty cool, right? So let's talk about how we can overcome opportunity cost. When we look at our net worth, it looks something like this over time. This is like a timeline of our life, and the horizontal line is like a net zero. A net zero. So what do we do when we need to get a loan right away? We have to go below net zero to get that truck or to buy that house or whatever. We go below net zero, and then we start making a payment, right? Brad, every single month we're paying on that loan, climbing and crawling and scratching our way back up to net zero again. Right about there is where we call Dave Ramsey and scream, "I'm debt free." And then what? Now the loan is paid off, but now our car is smelling like French fries. The kids are growing too big, so now we got to get another loan. We got to climb our way out of that mess too. That's the life most people live their entire life on that treadmill, just profiting to the banks. What's the alternative? Well, again, land the plane, wait for the wind to die down, and pay cash for everything, right? Nil wind. We save in our savings account. We pay cash. But Brad, I'm curious. Let's say we save up 70 grand to buy that truck we were talking about just a minute ago in a regular bank account. 70 grand saved. Let's say it was earning 1% or whatever in our savings account. Nice, juicy return of 1%. Even if it was giving us 1%, even if it was 5% a year, once we withdraw money out of our bank account, how much interest do you earn on money you take out of your bank account?
That's going to be zero.
Zero. That's a good one. Good. Zero. And so we break compound growth and we got to do it all over again to buy our next truck or car, kids' college or whatever. So doesn't this look a lot like the debt staircase we just drew below? So we're always trapping ourselves on net zero. But what if you could have an uninterrupted compounding financial vehicle that grew even when we borrowed against it? We continued to get that nice growth on our cash that never stopped, but only went up, even when markets were crashing. We could borrow against ourselves, pay ourselves back, pay our policy loan back, and continue to get the uninterrupted growth at the same time. Let's see what it looks like. All right, so here's an example of a real life policy. Let's say that I'll just use these examples. Of course, everyone's numbers are different, but let's say that this guy here, he could set aside $1,500 a month into a life insurance policy like I've been describing. Now, again, you could cut a zero off this if that's too rich. You could add a zero onto this if you'd like to. It's all proportional, okay? So all the numbers are proportional, but let's say he's putting in $1,500 a month. That's $1,800 a year going into the policy. See that there, I hope. And what you can see too also is in year 3, he's already got $40,000 of cash value built up, and he's got $750,000 death benefit. That's awesome. So it did cost him a little bit of money, right, Brad? In the first year, he put in 18 grand. He's only got 11 grand. So that's a cost of insurance right there. But we can also admit that that's way more cash value than old-fashioned whole life would have had. But it did cost him some money. So what about by year 3 to year 4? He's got 40 grand in cash value in year 3. And by year 4, he's already got $58,600. That is an increase of how much? Looks like about $18,400, right? So Brad, the cash went up by $18,400. How much in year 4 did this man put into the policy? I'll circle it for you. How much did he put in?
It looks like 18,000 or
yeah. Yeah, exactly right. 18,000, but it went up by $18,400. So wait a minute. He's got a death benefit of 800 grand that year. Who paid who for that life insurance? Well, the insurance company is now growing the cash by more than he's putting into it. Exactly. Benton says dividends. Exactly. Now, going all the way down the page here, look at this. At age 70, he's already smashed in there all his money that he wants to put in. Now, he could fund it for 5 years, 10 years, 20 years. This guy's funding it for a long time, 35 years. You could stop sooner if you want, but he's accumulated. The one number I want you to remember is $1.26 million. That's awesome. Way more than he put into the policy over that period of time. $1.26 million. This thing grew guaranteed with no market risk. Okay, so 1.26. Remember that number. Now we're going to look at the exact same policy. This time, this guy is going to take loans against his policy starting in year 4. He's going to take a loan for 35 grand. Maybe he's buying a truck. Maybe he's buying some real estate, rental properties or whatever. And he's going to repay that loan over 5 years. Oh, by the way, who's in control of that? Who gets to decide how he repays that loan? Is he in control, or is it some banker in control? Who's in control? He's in control. I like it. That's right. So over the same period of time, let's go down the page. He borrows, pays back, borrows, pays back. And he's at the end, wait a minute, what's that? At age 70, he still has $1.2 million, $1.26 million, as if he never touched the money. The cash continues to grow. And oh yeah, he also got those 6 rental properties. Love it. So anybody have any quick questions before we move on? I do have some more to cover here, but I want to pull over for a minute, see if anyone has any comment questions. You can either raise your hand or put it in the chat.
Ben had a question earlier about interest. Was there any interest on this?
Yes, there may be a slide coming up on this. Yes, interest, that's what makes this a real loan. Obviously, this is a policy loan, and without interest, it would not be considered a loan, and loans are why these policies are available income tax-free when you access the money. So I love that it's a loan. Now, I paid a little interest. You could do the math on this. He borrowed $35,000 and then he repaid it. Looks like about $38,000. So he paid about $3,000 of interest over 5 years. $3,000 of interest over 5 years is, let's do the math on that. 3,000 divided by 35,000 divided by 5 is, he had an APR of 1.7%. 1.7% annual percentage rate. Is that a good deal for borrowing money?
I'm going to say hell yes.
Hell yes. All right. Now, meanwhile, his cash was growing, compounding. on all the money as if he had not touched the money, such that he's got arbitrage. You guys know arbitrage, right? You earned more than you spent. You guys know arbitrage in your business. You might spend $1,000 to get the materials and costs, whatever. You might make $10,000 to do the job. That's arbitrage. Your arbitrage was the spread there, $9,000. Same is true with this policy. All right. Okay to move on. Any other questions?
One question that came up, and I don't know if this is the exact, Benton says you have to repay, but my question is, let's say you, in this scenario, you take out the 35,000 and then you die. Like, how does that, is that just come off of the payment, just like the $70,000 truck did?
Yeah, you'd just be seeing a slightly lower death benefit. Plus the family would get your car too. You know? Great question. You can raise or lower. Yes, Chris, you can raise or lower the contributions. Yes, they are very flexible up to a point. Yep. And there is no required repayment plan. This guy's paying it back, as you see here. But you're deciding, you get to decide. You're the banker. You get to decide how you repay this loan. All right.
Do you have to, when you take the money out, do you have to like say how you're going to do that, or like,
No, they don't even ask you for a repayment plan. When you borrow from the policy, it's just, here you go. And then they'll send you a note saying, hey, here's your loan balance. You can repay us as you wish. But again, the insurance company knows that you'll pay them back because eventually we're all going to croak. So they know they're getting paid back someday. Yeah. And Benton, the death benefit is the same, just like the cash value. Notice the death benefit is 2.18 million at age 70. Well, here it is without loans. It's 2.18 million without loans. So cash value and death benefit remains the same whether you borrow from the policy or not. What we're doing is we're just accessing the cash value as collateral for our things that we need in life. This could be a rental property, cars, vacations. I took a policy loan to invest in some real estate. I've taken policy loans to go on a month-long vacation to Hawaii. You can use your policy to invest in your business. There's no prohibited transactions like there are with 401k loans or other types of, loans. And there's no loan officer telling you that you can get access to this. It's your cash. Nobody's at the bank telling you can't do that. You can't do that. You get to pull the money and spend it on the casino if you wanted to. I don't recommend that, but you can do that.
And
all right.
One last question on that, Mark, is is the interest rate, is that like an adjustable rate, or how does that work?
Well, it can go down or up, but if it goes up, this gets to an important piece here. So it's a great question. And then I'll move on from questions for a few minutes to get through some stuff here. But the interest could go up with inflation. It could go up. Could it go up a lot? Probably not, due to how they charge interest. It's a simple interest schedule. But let's say it went up to 3% or even 5%. Where does that extra interest go? It goes to the insurance company. And in this case, this is a mutually owned life insurance company. Mutual means it's owned by the policyholders. Who are the policyholders? Oh yeah, you and me. So where did all that extra interest go? It went back to you and me. So our dividends go up when our loan rates go up. So I'm kind of hoping that interest rates on policy loans go up because it means my dividends will be going up too. So guys, if you start noticing interest rates on policy loans going up, the party's going to be at my house because we're going to be getting some higher dividends. Benton says it's like a co-op, exactly like a co-op, exactly like a co-op. Yep, many ways. All right, so just because you might have a few extra candles on the birthday cake or you might have some health issues, don't worry, you don't have to count yourself out. You are still eligible. You can be the owner of a policy even if you're not the insured. And if you're not sure if you have the cash to fund a policy, don't worry, we can talk about that in our financial analysis meeting. Now, I've kind of gone over the good sides. Let's talk about the downsides of this strategy. Again, as a certified financial planner, I don't just recommend everyone rush out and get a life insurance policy for a lot of reasons. Here's a few. One, insurance costs. Even though we design these things efficiently, there are still some insurance expenses that you could see clearly. Remember, he put in 18 grand. He had 11 grand in the first year. The difference is the insurance expenses, and we cannot fully eliminate those. So be aware of those insurance expenses. You also need to be able to save. You also need to be comfortable with the fear of missing out. When the stock market is tanking, we feel great having guaranteed growing cash values like we have in our policies. When the markets are going up, sometimes you can have that fear of missing out. And remember, it is a long-term strategy, not a get rich overnight scheme, right? Now, I do want to also mention that the biggest risk in this whole conversation is the risk of the wrong advisor. The wrong advisor. I've had more people tell me, probably thousands of policies over the 11, 12 years I've been doing this. Oh yeah, I've got one of those. Oh yeah, I got one of those. And then they show it to me. Unfortunately, what their advisor did not know can hurt you. Unnecessary fees, growing too slow, penalizing you when you borrow, tax disasters. So you want to make sure you're working with a true Bank on Yourself professional. We'll talk about what that is in a minute. For real quality control. A Bank on Yourself professional, we'll talk more about in a minute, is the only credentialed process and accreditation process that makes sure your financial advisor knows what he or she is doing. So these policies are private. Nobody else knows you have one except you and the insurance company. There's no approval process for your loans. There's no government limits on contributions. There's no early withdrawal penalties. There's no required minimum distributions like there are with IRAs and 401ks. As I mentioned, there's no prohibited transactions. You can do whatever you want with the money. It's your cash. Spend it on your kitchen remodel. Spend it on your next business trip. No custodians looking over your shoulder, and no red tape. Here's a picture of what one of our recent colleagues and clients sent me. Dan was a typical investor, buying stocks, investing in real estate and so forth. He went through the tech bubble. He went through the housing bubble, and basically his net worth was flat for 12 plus years as he tracked it. And then in June of 2009, he opened his very first Bank on Yourself policy. And look at the real wealth rather than paper wealth. His real wealth began to climb, and his net worth has nearly tripled in 10 years. All right. So I'm going to pull over. We have more we could go over. I've got more examples and more fun we could do here. But I want to pull over again and just see if there's any other questions, and check in on our time too, Brad. Are we okay for about maybe 10 more minutes, or are we needing to wrap things up?
No, I think we're good on time.
Good. Okay. All right. Then I'll try to zip through this last piece in about 10 minutes. But guys, if you need, this is the best website, I believe. Julia, correct me if I'm wrong. But I think that's our best website for folks to reach us. So we've got a special website just for you guys. So what we're going to be talking about for the rest of our last 10 minutes, and then we'll open it up to questions, is banking at the you and me level. We're going to be talking about how Bank on Yourself can actually improve with inflation in a couple of ways. We're going to party like it's 1980. All right. I don't know if anybody had a hairstyle like this in 1980, but I'm hoping it comes back. Brad, what do you think, man? Would I do okay with a mullet like that?
I think it's already back. I saw a guy at the gym this morning had one just like it.
Oh no. Oh no. Well, keep in mind, premiums are set for life, meaning they do not go up. Premiums on life insurance, whole life insurance, do not go up. Term insurance, they do go up, but premiums are level for the rest of your life. That gets easier to do in inflation. Okay. The cash value and the death benefit, someone asked this question, the cash value and the death benefit grow every single year when the market is crashing, when the market is up. So as we have more profits due to higher inflation, there's going to be higher dividends. Now, this is a picture of one of the companies I like to work with. I work with a number of insurance companies to design these. And this is one of the companies. They've never missed a dividend in over 100 years. 100 years. So what was the market doing when this thing was kicking out dividends to its policyholders? I'll show another quick example. Here's a guy he's 40. He had a large chunk of money. Again, take a zero off of this if it's too much money in your mind, or add a zero on if you want to. He had $400,000 that he could set aside. It was just, he had sold some real estate. So he put that $400,000 into a life insurance policy, and he immediately had $378,000 of liquid cash. So again, That's not tied up money. That's money that is his. He can access that cash. And, oh, by the way, he had a $1.7 million death benefit, more than 4 times more than what he had put into the policy. Amazing. Day one. Now, this cash value certainly is beating inflation. As you can look down the page there, it even grew beyond what he put into it just by year 3. See that? And by year 8, keep that number in mind. Remember that number, $507,000. Kind of just remember that number for a minute. 507 grand in year 8. This is without any loans. But he doesn't want to just let it sour inside the policy. He wants to keep that money moving. Velocity of money, right? So he decides he's going to take a loan against his policy. Within about 30 days of starting this policy, he borrowed out $360,000 to invest in a syndication multifamily real estate deal. And his plan is he's going to pay it off in about 8 years when they exit the syndication, when they're done with the real estate. Okay, so over that 8-year period, what happened? Well, he paid some loan interest. In this case, he paid $54,000 of loan interest. That worked out for him to be about 2.1% annual percentage rate. Not bad for borrowing cash. So that's 54 grand. Youch. That's still 54 grand that he had to pay in interest. But wait, the policy earned $107,000. That's more than 54 last time I did my math. 107,000. He put in 400 and it went up to 507. That's $107,000. That means he earned more than he spent, $53,700. That's his arbitrage. Any feedback, comments? We got the cash value. He takes that loan, has that APR of 2.1%. Cash value grew to $507,000, and his arbitrage was $53,700. Yep, great stuff. Yeah, he paid that. How did he pay back that 360? That's a big loan. How did he pay it back? Well, when the syndication deal sold, he got his windfall. After they sell the properties, the mobile home park, whatever, he's getting that lump sum back plus all the gains from that syndication deal. All right, cool. I see Keller says he's got to get back to work. Go get it, man. If you can, jot down that website, hammerandgrind.gr8.com. Rock and roll. All right, here's an example. He just does it again. So wash, rinse, repeat. This thing gets more and more efficient. Instead of a $53,000 arbitrage, he does the same thing with a bigger real estate deal. Now his arbitrage is $107,000. Love it. I'm going to skip past a lot of this. My question would be, how many times can I do that? So here's some again, some risks to be aware of. Do not end up with someone who just Googled this. You know, if your financial advisor or insurance agent just said, oh yeah, maybe I can check that out, or I'll look into it, or yeah, I can do that for you. Run, do not walk, run. You might end up with the wrong company or the wrong insurance contract. You want to partner up with companies that have been kicking out dividends for over a century. And specifically, you want to make sure your insurance company uses what's called a non-direct loan feature. Non-direct loans is what allows your money to continue to grow even when you borrow against it. Not every company lets you do that. So when we sit down and chat with you, we'll look at least 8 ways to free up your money so you can put it into the buckets that you want it to go into. You know, remember that big chart of all those red zones where the money is typically living? We'll look at ways to free up some of those dollars to help put it into places you can control it. Keep in mind that no 2 policies are alike. We custom design these, so you can find out what your bottom line numbers are by requesting a BankOnYourself strategy and a free no obligation analysis. All you have to do is go to hammerandgrind.gr8, or great, as we say, hammerandgrind.gr8.com. And we'll schedule a 15-minute phone strategy session with me or one of my colleagues to really see if this tool is a good fit for you. So the good news is today is the first day of the rest of your life. But what are you going to do about it? If you think we're done with inflation, if you think we're done with market volatility, no way. No way. This could be the first day you become your own source of financing, become your own economy, build your own money supply, help you reach your financial goals guaranteed. And that's very hard to say that word guaranteed in the financial universe. but we can use that word when we're talking about dividend paying whole life insurance. So if you'd like, go to hammerandgrind.great.com, and we can happily chat with you about your questions. All right, so I'm done with I'm off my soapbox. Brad,
Awesome,
what if
Mark.
any feedback do you have, questions?
No, I just want to say I let anybody on the call know that if you don't know me that well, like I'm very very protective of my community. So I don't just let anybody, come in and pitch products and services unless I wholeheartedly believe in what they're doing. And Mark's the real deal. Like I said, he was on my podcast a couple times. So I would not be recommending Mark and having this program if I thought there was anything shady or anything that was not legit. And what I love about Mark is that even as somebody that came from the Dave Ramsey, policy or background, I'm a big Dave Ramsey guy. Mark was too, and we all, that does help a lot of people, but it's just doesn't always apply 100% across everything. So, any questions you guys have now? I know Mark's probably got to hop off here in a minute, but any other questions you guys have to get answered?
What are all the variables that define the policy and figures? Wow, Benton, great question. I'm not going to be able to answer that in this quick call, but I'm going to kind of just melt everyone's brain for a second here and put this up. Again, don't feel like you have to memorize all this. This is just a quick dashboard of all the different ways we need to make sure the policy is designed correctly. There's over 30 different characteristics that make up a Bank on Yourself policy. And that's just the product. What about you and your particular designs and what your goals are? Maybe you've got a big boost of income. I'm working with a plumber north of me, and he's doing a great job in his business, and he has a very busy season. And then he'll dump a bunch of money into his policy at that point and then cool it for the rest of the year until the next busy season. Well, we got to design the policy with that kind of flexibility in mind to be able to manage that. And guess what else he does? He then uses that policy to pay his taxes every year. Why would we pay cash for our tax bill? Good night. Why is that a thing? We should use our policies at least as an option when we're talking about ways to pay for our big expenses. This tool can continue to grow your money even when you're paying your tax bill. And he uses it too for his large expenses. He has some large trucks he buys and so forth. So anyway, good question, Benton.
He had another question about what would happen if everyone borrowed against their cash value. Would that bankrupt the program?
No, that'd be a great day for the insurance company because that'd be that much less they'd have to pay in death benefits. Remember, that'd be because remember, they keep the death benefit on hand in case I croak today. So they don't just have my money to borrow available for me. They have my entire death benefit available for not for me, but for my family. So there'd be no problem for them to loan out every last penny. And that'd just be less money that they'd pay out if we all croaked the next day.
Awesome. I think he's got one more question there, Mark.
Terms can be flexible or more rigid, resulting in different cash values and death benefits. I'll need just a bit more context, Benton, to your question, sir. Tell me, what do you mean by terms can be flexible or more rigid? Do you mean the loan terms?
Well, you're just talking about how you can continue paying on a regular schedule. Sometimes you may pay more. Sometimes it's like your payment. There could be like a prescribed. I'm on a $1,500 a month. And that's what it is. But sometimes I don't have it, so I'll only put 500. But then next month, hey man, we got a lot of money. I'll put in $5,000. So it's flexible, which I imagine the cash value and then the death benefit is also kind of flexible as well. Is that fair to say?
Yes. If I understand your question, the policy is going to do its thing, whether we pay the loans off quickly or slowly. The policy continues to grow. It's much like a home equity line of credit. Your house will continue to change in value, whether you borrow against that house or not. And you can pay off your HELOC slowly or fast, but the house is going to still just do its thing. Zillow doesn't care if we have a HELOC against our house. The value is the value, right? So similarly, the whole life policy will continue to grow, whether we borrow from the policy or not. And you can then flexibly or more systematically repay those policy loans, but the net cash value and death benefit would be the same. Does that get to your question?
Okay. So
yes,
I
appreciate that analogy.
Yep.
Thanks.
just to piggyback on that. So if you set up, your benefit, let's say it's $1 million death benefit, are you locked in to pay that a minimum fixed amount each month? Let's say it's the $1,500 a month. Like, are you locked in at that each month and you can't change that, or?
Good question. Well, so again, if we designed it to hold $1,500 a month, generally the majority of that 1,500 is optional to you. And sorry to mix metaphors, but it's kind of like buying a gas, like a V8 truck, let's say. You can fill that gas tank up, however many gallons it can hold, or you can fill it up 2 or 3 gallons, no problem. There's flexibility up to a point. You can't overfill the gas tank. So in that example that I showed earlier, that guy, he could only put in $1,500. That was his ceiling.
Okay.
But he could always lower it down to, $700 a month, let's say, if he got into a tight spot, or even $500 a month. And he can even get it down to 0 for a little while too, if he's in a really tight spot. But ultimately, he'll turn off the premium. He'll say, I'm done. I'm ready to retire now. And he'll just turn off the premium altogether.
Gotcha. Okay. And you obviously, if somebody wants to book a call with you, like, you're going to more thoroughly explain and answer any questions they have. So
you bet. Happy to. I think, I know I've you guys have been very generous with your time today, and you've asked great questions. So I'd be happy to stick around for another few minutes if anyone has anything else, but I'll let you take it from here, Brad.
Benjamin just had one come in about how far out can the loan be repaid?
I had a guy one time. This is a cool story. I had a guy, he bought a house next to a very famous home. I'll just say it that way. If you grew up in the 80s and 90s and you had a full house, you'd know the house I'm talking about. Let's just say it that way. And so he was doing a renovation of this nearby neighbor house. And it was a $800,000, $900,000 in that ballpark renovation cost. And so he put money into a policy, dumped a lot of money in from a brokerage account in his case. And then he immediately borrowed out all the money he needed to do the renovation. And he's going to take the next 30 plus years, is his plan, to take the next 30 years to repay that loan to the policy he owns. Now, the beautiful thing there is the policy cash value is going to be, north of $1 million, well north, maybe $2 million by the time he's done paying off that loan. And he has complete control. If he's lost his job at some point over the next 30 years, he could just skip a few payments till he's back on his feet. And yes, I do have folks who use this as an alternative to a regular mortgage. I've even had folks who had a mortgage at their house and then they used their policy to wipe out their mortgage. And this one dude, he actually took a photo of his mortgage burning in a fire pit in his backyard after he used his policy to wipe out the mortgage, which I thought was really cool.
This is, I know it's different, but it's kind of similar to like a reverse mortgage, sort of, where you're, borrowing the money up front and then paying it off once you die.
Mm-hmm. Yep. Anytime you can borrow against an asset and it continues to grow, it's a pretty rare treat. Can you do this with a home? Yes, but are homes guaranteed to grow? No. Could you do this with a brokerage account? Yeah, they're called margin loans. Are brokerage accounts guaranteed to grow? No, definitely not. 401ks, you can borrow from those too, but again, same problem. And they're even worse because you got to pay your taxes on those loan repayments twice. So yeah, great stuff. Guys, check it out. It's something I didn't expect I'd be talking about as a certified financial planner, but I just find it so compelling, especially for the business owner. I mean, just think if you had this and your competitors didn't, and banks stopped lending again, like they're probably going to do at some point, maybe this year, maybe next year, who knows? Who's going to win in the competitive space in your neighborhood if you've got a big pool of contingency cash and all the other guys in your field are having to beg a banker? Who's going to win? Benton asked, what's the downside? Yeah, like I said, insurance expenses, fear of missing out. If you just want that 30% juicy return from the stock market, these policies are going to do 4 to 5 to 6% over the long term. So this is going to bore you to tears if you just crave that, that roller coaster. That's about it. And again, the biggest downside is if you get the wrong policy, if you design this thing improperly. It's kind of like an elevator. If you design an elevator improperly, doesn't matter how pretty it looks inside, it's going to go down when you push the wrong button. So make sure you work with the right advisor.
All right, guys. Well, I know we're a little over on time, and Mark's got to head out. So I appreciate you guys hanging out on this call. I will send out the link that you can use to schedule. What do you call that? Like
a 15-minute phone call conversation. We'll just answer questions and have a discussion about where you're at and what questions we didn't get to answer today, that sort of thing. So yeah, thank you.
Awesome. We call them discovery calls in our program. So if you want to have like a short little discovery call with Mark to find out more, see if what you can do to set this up, I'd highly recommend doing that. So, and like I said, I'll email that out, because if you registered for this webinar, I have your email and I'll send that link out to everybody. So appreciate you, Mark. Thanks so much for being on here and sharing this with everyone. And guys, yeah, appreciate you being on here as well. So everybody have a great rest of your day. Thanks so
Brad.
much.